Hi guys, I believe I'm online right now, and we're going to be talking about construction loan today for developers and investors and builders. I'm just trying to set up my screen, but it's a kind of new thing for me, anyways. So we're going to be talking about construction loan today. So the definition of a construction loan, everyone knows about it. It's very basic information. Short-term loan for construction, for financing a building for a ground-up construction. Today we're going to be talking about ground-up construction, by the way. And renovation is also a construction loan when the purchase price of the property is less than the rehab cost. So we consider that as a new construction, ground-up construction loan. The purpose to provide funding for land acquisitions and construction loan and related expenses. Types of construction, that's going to be land development loans like horizontal loans for permits and plans, and also for services like sewer, water, electricity, all those services for the project. The construction only loan, which is vertical loan, cover cost of construction plan phase. Construction to permanent, that's another thing. When you've completed the project, we have to make sure you have a construction to permanent facility at the end of the construction. Learning objects in this presentation, we're going to be talking about again and understand basic construction loans, identify the types of construction loans available, and many more things. Stages of construction loans. So first, the pre-construction land acquisition, permitting and zoning, as I said, and pre-construction agreements. So that is when most people come to us when they purchase land. And just by the way, when you purchase land, um, that loan it's called land loan as is because you don't have permits. If you purchase land with the permits and services, everything ready to go, shovel ready is called, then you can get a construction loan right away because your project is ready to go. But if you just buying land, then it's just a land loan, and then you spend money on the permits and services. A construction phase. During the construction, you have draw schedules. Uh, Lenders do inspections of the construction progress and budget management. Post construction is loan payoff or conversion. Like I said, after the completion of the construction loan, you should be able to do conversion to the permanent loan, or some sort of exit strategy. Certificate of occupancy, that's when you're ready to move in, or the tenants are ready to move in. The permanent financing arrangement, that's we already talked about. Construction, construction loan products. So we have variety of things under construction loans we do. First and foremost, what we do, private money construction loans, because most of the banks don't like construction, and if they do, they have very, very strict guidelines. So they end up having a private construction. We do a lot of private money for construction loans. Either they're residential or commercial. Either way, it's a less stringent process. You can close the deal within 15 to 20 days sometimes for smaller deals, and larger deals, 30 to 45 days. Conventional construction loans, that's when you own the property and you use the property owner use the properties. That's for conventional construction loan. That's an alternative to SBA. HUD 221 D4, that's for multifamily property, 5+ units, and it is a longer process to get approved, but it's very economical, very less expensive, and it converts into permanent after the construction completion. But the lengthy process, it takes sometimes 9 months to close the deal. So you have to be really patient about it if you want lower interest rate and you don't want separate loans. Because when you do construction loan itself in the private money side, you have to have second loan, which is permanent loan, or bridge loan to pay off the construction loan, and then you get permanent loan. So sometimes you take 3 loans one by one after construction, bridge and a bridge to permanent. SBA construction loans, that's for owner user properties. Like we specialize in hotels, gas stations, truck stops, car washes, these kind of properties. We help clients to build under SBA. USDA construction loans, that's also for those kind of properties, hotels, gas station, truck stop, car washes. The only difference is USDA is for properties which are located where the population is less than 50,000 in that area. And there's a link for a USDA map where you can put the address and see if eligible or not. Mezzanine financing, it's also a part of private money. It's kind of a second lien. It's also preferred equity financing. It's also private lien. Preferred equity is a lender is taking the equity portion on the deal. That's, again, if you already have a construction loan and then you want a mezzanine financing, it's second lien or preferred equity. If you're short of money, short of equity, then you can bring that and we can help you out in getting mezzanine financing or preferred equity financing. Eligible asset types: single family units, 1 to 4 units, multifamily, 5+ units, single family residential subdivisions. That's what we do a lot. Again, it's residential is only under private money. It's nothing under SBA or USDA. It's mostly private. Office, medical building, retail plazas, industrial warehouses, hotels, motels, gas station, car washes, mixed use, retail at the main floor and apartment upstairs, self-storage, assisted living facilities. A key question to ask to the sponsor. It's very important. If you are a borrower listening, or if you're a broker listening, very important. You must know these things. What is the experience with similar projects? If you have done these kind of projects before, for example, if you're building a 50-unit multifamily property and you have done these kind of projects in recent past, then it's much more feasible to fund these kind of loans for you, and provided you have other things available. Have you completed any projects in the market? So you have completed any project, if it's any project you have sold, built and sold, or rented out, we want to see those. Equity position, very, very important. Sorry, I just have to change this. Okay. Equity position. Oops. How much liquidity do you have? This is not the equity, I would say. The equity position is your down payment, your skin in the game. your sweat equity or your cash equity when you purchase the land. How much money did you spend on the soft cost, on the permits, on the services, all those things. Sorry, there's a technical difficulty, I guess. All right. All right. We're talking about eligibility, equity position. So, when did you buy the property? How much did you pay for it? We want to see if you purchased the property just now, like 6 months ago, how much did you pay for it? If the property was purchased less than 2 years ago, we consider the purchase price, not the appraised value as of today. So we want to make sure that the purchase price and the appraised value, whichever is lower, we take it. If you purchase property like 5 years ago, 10 years ago, then we may consider the property value as of today with based on the permits and plans and services you put in. Liquidity portion is, as I was telling about, it's about how much liquidity you have other than the closing cost. That will stay in your account. Oh, we're not going to use it, or you're not going to use it. We will just, it's a cash reserve just for the rainy day. Project feasibility. What demand studies have you conducted? Like, do you have the feasibility study? Do you know what kind of properties are selling for what price in that area? You can't build something for $10 million in that area where nothing has been sold in that area for more than $5 million. We have to see the comps. If there's no comps, no deal. What are the pre-leased, are there any pre-leased tenants or buyers? So specifically for commercial properties, if you have any tenants in place, because commercial tenants can sign the lease agreements even before you're building, build to rent. They can sign the agreement like 2 3 years ago prior to the construction or the completion of the construction. So we want to see that. That's going to make your application very stronger. Do you have financials of the tenants? Is it a franchise? So if it's a franchise and the tenant is a franchise and they have multiple locations and the franchise has multiple locations, it can make the application stronger. And if it's a large project and the single tenant, we want to see their financials of the tenants who are getting signed the lease even prior to the construction. That again, that's going to make applications very stronger if you have franchise signing up. Any franchise. It depends on how many locations they have and how successful they are. And that particular franchisee has multiple locations with that franchise, then it makes big difference. Do you have potential tenants when the construction is completed? As I said, LOI, if they have signed a lease agreement or letter of intent. Second set of questions I would ask, financial stability. How much equity are you contributing? That's again the equity question I put it here. So that's very important. How much equity do you have? We receive many applications where clients purchased land a few years ago and they just treat that equity as an equity and there's no more equity. They purchased land for $500,000. Now they're saying the property price is $2 million or $3 million, just the land itself, and no more equity. But you have no skin in the game. You have only 500,000 or $400,000 skin in the game, and you're asking for 8, 9, $10 million of construction loan. That is very, very complicated and very difficult to approve. You have to have skin in the game. Lender's point of view, you have to have skin in the game. Can you provide financial statements of the business? If you are continuing, if you have construction business, if you're building properties and selling properties, we want to see the financial statements of that business. But if it's a brand new LLC, we definitely want to see your personal financial statement to see your net worth, liabilities, assets, everything. How are you going to make interest payment for 12 to 24 months, interest reserve? So in the construction loan is usually interest only payment. So we want to see if you have enough money to make payments for next 12 to 24 months that during the construction period. Term credentials. Who are the contractors and architects? What are their track records? We want to see that as well, especially when you're building a large project. If they've done these kind of projects before. Exit strategy, very important. What's your plan for loan repayment? Will the loan convert to permanent financing? What is the plan to convert into permanent loan? Any LOI from the lender? I mean, usually people don't have LOI because it's way too ahead. You have 2-3 years sometimes, but if you have it based on the projections, based on the income you're gonna have after the completion, if you LOI from the tenants, it makes a big difference in the application. Required documents. I think we're not going on live on LinkedIn. Let me just double check. This is not what we do every day, so please forgive me if I'm taking longer time. So I think I have to do it again for LinkedIn. Showing it's streaming on LinkedIn, but it's not. Um, all right. Yeah. Okay. Anyways, let's focus on this one here. So required documents. 10 minutes left. Personal financial statements. That's very important. Very, very important. Most clients or brokers, they're so reluctant to give us personal financial statements, but it's deemed impossible to get you anything before we have these things. Schedule of real estate owned, very important. So these are the very basic tax returns. We don't need it right away. Business plan, we don't need it right away. Personal financial statements, schedule of real estate owned properties. What do they own? How many properties they have flipped? A schedule of real estate owned. We'll talk about these things, particularly these things one by one. But for now, we're just gonna do it brief, like schedule real estate owned. How much did you pay for the property when you purchased the land? How much money did you spend on the property? And what was the sale price? So we want to see the profitability of your previous projects. If you were not profitable builder, that is going to make a challenging situation for us, because what are the chances you're going to make it profitable again? So we want to see the story. We want to hear the story. Property documents, appraisal report, environmental study, and title report. These can come later. Property appraisal report, sometimes builders, they already have it based on their as-is value and complete value. So which makes sense, and it's much more easier to qualify for the loan. We already know what the property value is going to be after, if the appraisal is legit. Required documents again, construction documents, contract agreements, detailed budget. Budget is also very important. This is one of the things what we want to see upfront, along with the personal financial statements and schedule of real estate owned. Construction timeline and schedule. That's also important. Loan application, lender specific loan application, credit history, sources and uses, pro forma, insurance coverage. So along with the personal financial statements, schedule of real estate owned, detailed budget, sources and uses, and pro forma. These are the 5 major things we need with the executive summary. So just write a story of what is the project, where is it, how many projects you have done, how much your construction cost, how much did you pay for the property when you purchased it, when did you purchase it, how much money did you spend on the services and permits and architects and plans and everything, how much liquidity do you have, how many cash equity do you have at the moment, how much already you spent, how everything you can write in the executive summary, like a story of the deal. That is going to make a big difference when you get the application. Evaluating construction budgets. That's I mean, we can talk about it, land cost, hard cost. That's usually builders, they already know these things. What is the land cost, what are the hard costs, what are the soft costs, what are the contingencies, and common pitfalls, underestimating costs, insufficient contingency reserves. So sometimes builders, especially the new builders, they underestimate the cost, always on the lower side. They think that they can build a project in a certain amount, but it goes up in value, up in expenses. Always it does. Even the experienced builders do that. Example calculation: total budget $10 million, land cost 2, hard cost 7 million, and soft cost $750,000, contingency $250,000. It becomes $10 million budget. This is a very basic information for builders. They already know these things. So these are the lending guidelines or programs. For residential, we're starting from $500,000. You can go up to 100 million. Actually, it's $10 million. That's for residential, single family, or 1 to 4 units. For multifamily or commercial properties, all commercial properties, everything starting from $1 million. And the sky's the limit. With $100 million, we can go up to. Loan to cost 85%, up to 85% for residential. And for commercial, 65 to 85% loan to cost. So when I say up to 85, that's for great credit, great experience, great location, great net worth. Everything is great. Then you can go up to 85% of the total cost. On the commercial side, usually it's 65% for very selected properties. For multifamily properties, we can go up to 75 as of today. If it's a HUD, we can go to 80%. SBA, USDA, we can go to 80%, or on our USDA, sometimes we can go up to 90 or 100% loan to cost. That's a different subject. We'll talk about that under USDA program. On commercial properties, retail or industrial, warehouse, or build-to-suit properties, we can go up to 85 provided you have tenants in place. If you have tenants in place already, we can go up to 85. But generally, 65 is the best bet. That's where we can go up to. Rates starting from $9.99 for residential. And for commercial, starting from 9% to 12%. And most people say, why it's lower than residential. Residential, it's mostly private. I would say 99.99% private lending we do for residential construction loans. For commercial, we do government loans, SBA, USDA. So they're from prime plus 2, prime plus 2.5, that range. So they can be starting from 9.5%. It can go up to 12, even more than that. Term is for residential 12 to 24 months. It's by default 12 months. And for commercial, we can go from 12 to 36 months, because construction for commercial is always larger than residential. Interest-only payments for both cases. There's no amortization. End of the term, you pay off the balloon, make the balloon payment of the total amount, and the location is nationwide. So that there's a catch in nationwide. Every project cannot be approved if it's anywhere in the country. It's subject to the property location. Again, if you're building a property $10 million and nothing has been sold for more than 5 in that area, that's going to be a challenging situation. So we have to make sure that the property surrounding, unless it's USDA doesn't care about it. USDA can do commercial loans in rural area versus no comparable based on the projection of pro forma of that particular business. Qualifying criteria. That's again a basic information. Experience, minimum 3 or similar projects in past 3 years, or GC with experience as a guarantor. So if you have no experience at all, that's mostly for residential, I would say. If you have no experience, the GC has to come as a guarantor, sign the person guarantee, and then they have to have more experience than you. I wouldn't say 3 years. I would say 12 to 18 months or 24 months. Within the last 2 years, you have to have at least 3 minimum projects. 650 is the minimum credit score. May get exception, especially on commercial properties. Commercial properties, we want to see more on the property side, not on the personal side. You cannot have a money laundering or any other situation or bankruptcy. We want to hear the story of the bankruptcy. Why did it happen? When did it happen? There's all the circumstances. Minimum DSCR ratio, that's after the completion. After the completion, if the DSCR ratio is less than 1, so DSCR ratio, I just want to clarify that the debt to service coverage ratio. If the, the payment, the rent payment is not covering the debt payments equal or more, that's going to be a challenging situation. Private lenders don't care much, but they still want to see the feasibility, or what is the performa, how much money the project is going to be making after the completion, because this is how you're going to get the permanent financing. If you cannot get permanent financing because of the low DSCR ratio, the private lenders are so reluctant to give you money for construction, because their money is going to be stuck after the completion of the construction, because nobody's going to lend you money for permanent financing. So you're going to be in the loop of getting bridge loans over bridge loans every year, because your DSCR ratio is low and no lender is going to give you permanent financing. So try to have a construction project with the minimum of 1 or more DSCR ratio. Ideally, it would be 1.15 or 1.25. 1.25, great. Minimum liquidity, 5% of the cost of the construction project. That's what you have to have in your account as a cash reserve, or we want to see it. You're not going to use it. That's not equity. That's a liquidity. Money sitting in your account. Net worth. Most private lenders want to see net worth equal or more than the loan amount. So whatever your loan amount you're applying for, your net worth should be equal or more than that loan amount. That doesn't happen in the SBA or USDA. It happens in the private money side. And most people think private money is easy to get. It's easy because the DSCR ratio can be lower, credit can be lower, all those things. But they want to see how you're going to make the payments and the balloon payment at the end of the term. Sometimes it's a non-recourse loan on the private side, but on the SBA, USDA, and most of the loan side and conventional loan side, you have to have personal guarantee. But private money side, you can get away with it. Non-recourse is always more expensive. Recourse loan is less expensive. So if let's say you're getting 11% rate on recourse loan, but the client's insisting non-recourse, no personal guarantee, the rate might go 11.5 or 12%. Location, nationwide, again, conditions apply. Depends on the location, the metro area or a rural area. We want to see if you can sell the property or refinance the property after. The comps should be there. They're very important. If there are no comps, it's hard to fund unless it's SBA or USDA. Recently, we closed this deal, multifamily property deal, 40 units, loan amount of $14 million, interest rate 11.5%, 70% loan to cost. Total project was $20 million. The land value was 3.5 soft cost, and that was including getting the permits, approvals, clearing the lot. There are a lot of things on the lot, a little building on the lot, so they demolish it. It's getting services. Everything is going to costed them 1.5, and hard cost, the total construction cost were 1.5. Sorry, $15 million. So the sponsors, the equity, total cash and sweat equity, because they purchased the land a few years ago and it went up in price with the permits and everything, and their cash injection equity and their sweat equity was $6 million. So the location was Houston, Texas. So this is like a 70% loan to cost. Total cost was 20 million and the loan was 14. So it's 70% loan to cost. So that's about it. Let you go, guys. Thank you. This is my contact information. You guys can contact me. Company name is ACOM Capital. You've probably seen it on every page. 619-738-6474. Email Raja at acomcapital.com. and the website is acomcapital.com. You can email me with your questions and any concern you have any deal to discuss. We do both residential and commercial. A very important thing is equity. If the sponsors have equity, if you have equity in the deal, depends on the deal guidelines or deal size. Minimum 15%. It can go up to 35% equity. We can close the deal. So call me or email me to discuss. Thank you, guys.